Hi everyone, welcome back to Bill's Market Insights. Today, we're diving into part 3 of our series on long-term wealth. And we're talking about the king of assets. Even with the dips since the start of Iran war, gold has been on an absolute tear, up roughly 50% in just the last 12 months. If you have been watching the charts, you know this isn't just a minor rally, it's a fundamental shift. Amid the noise, one thing is becoming crystal clear. Gold is no longer just a panic button for when the S&P 500 tanks. It's becoming the actual bedrock for protecting your wealth. We aren't looking at a quick trade here. We are witnessing a structural transformation. Trust in paper money is eroding. And with the Fed's new direction and a shifting global landscape, gold is entering a brand new era. To understand where prices are headed, you have to look beyond the charts. You need to understand the two specific stages how gold moves. Stage 1 is a liquidity crunch. I call this the defensive compensation phase. We saw this in 2008, 2020, and even earlier this year. Think of it as a fake-out. When the market hits a major speed bump, big investors suddenly need cash fast to cover losses or pay down debt. Since gold is highly liquid, its price often drops at the very start of a crisis. The lesson? Don't panic. That dip doesn't mean gold is losing value. It means gold is doing its job as a financial world's shock absorber. Stage 2 is a recovery and rally. This is a real move. Once that initial need cash now panic phase, the true growth begins as the world realizes gold is the only safe place left to stand. Right now, all eyes on the Federal Reserve. With Kevin Walsh's confirmation and a more dovish team in place, the rules of the game are changing. They want to keep the economy moving, especially with the midterm elections right around the corner. As the Strait of Hormuz reopens and oil prices cool, the rate cut narrative will become the dominant force. Globally, trust in government-backed currency is shrinking. In this environment, gold acts as a firewall, protecting you from government overspending and the institutional mess-ups we see in the headlines every day. So, what is the play? Here's my 2026 playbook. Number 1, the hold. This is your core. If you already own gold, stay put. This 50% gain isn't a fluke. It's a repricing of the global economy. I suggest keeping about 15% of your portfolio in gold as your insurance policy against depreciating paper money. Build this slowly during moments of political chaos through buying dips. Number 2, the buy. This is a tactical move. If you're looking to go beyond the 15% core, don't chase the green candles, watch the rates. As the Fed continues to cut and oil stays low, look for opportunities to buy in small, disciplined chunks. Number 3, the sell. Only sell if you're over-leveraged, but do not sell during gold stage 1. When the news is terrifying and people are selling gold just to get liquid cash, that is not the time to exit. That should be the high conviction entry point. Even if you're over-leveraged, better to sell only at higher prices during gold stage 2. In the wild world of 2026, gold isn't just a place to hide, it's a bedrock of value. We have to look past the fog of war and the daily noise. When you combine the new direction of the Fed with the long-term decline of paper money, gold is one of the few assets that can protect your capital while still giving you room to grow. Stay disciplined, stay informed, please comment, like, subscribe, and forward this to your friends. I'll see you in the next one.